Welcome to the Asia Advantage with Dezan Shira and Associates, featuring business commentary and regulatory news about emerging Asia. Today on the podcast, we are in Beijing talking about issues and trends important to the region. With us is Devonshire-Ellis, founder of Dezan Shira and Associates, ready to share his expertise in doing business in Asia. Dezan Shira and Associates is a business advisory, tax, payroll, and accounting firm that specializes in the Asian region. What is a demographic dividend, and how are key differences in population structure affecting the economic futures of China and India?
A demographic dividend, in this instance, really refers to the population dividend that China and now India have and are about to acquire. The demographic population dividend that China had saw that in 1992, 20 years ago, the average age of a Chinese worker was 23. And that meant that China was able to become, with government policies allowing it, to become the global source of cheap manufactured goods which are available for export markets. China could do that because it had a young and available low-cost labour workforce, and it had that in 1992. That has now changed, and in 2012 the average age of a Chinese worker is 37. So he now has more responsibilities, there are more financial demands upon him. He's now married, he has a wife, a mortgage, dependents, and he needs to earn more money than he did when he was 23. So the Chinese government are well aware of this, and it means that China's labour force is becoming more expensive. They need to have more money in their pockets to cater for the additional responsibilities that they now have. China is a rapidly ageing population, but it is also a wealth-creating population. And we're seeing now for the first time that China has created, during that same period of 20 years, a mass consumer middle class, which is estimated to be about 200 to 250 million people. That's huge. And they are now in a position to buy imported products. 20 years ago, there simply wasn't the money to do so. Today, there is, and we've just seen the latest US Department of Commerce export figures for China, which for the first time last year in 2011, the US exported $100 billion worth of goods to China. So clearly the Chinese market today is able to acquire, purchase and pay for imported goods, whereas 20 years ago it could not do so. So that's the China story. The India story actually is similar, but it's a little bit behind, but with a difference. The average age of an Indian worker today in 2012 is actually 23, the same as a Chinese worker was 20 years ago. So that low-cost manufacturing dynamic is now shifting to India, also to ASEAN, where the average age of a worker is 24. So low-cost manufacturing is starting to move to these countries, to the ASEAN trade bloc, and also to India. That's not to say that India doesn't have a middle class of its own, because the difference between China when it started out is that it did not, whereas India has a long-term old money middle class of about the same size as China's today, of about 200 to 250 million people. So whereas China 20 years ago was all about low-cost manufacturing, India is now about selling to China. India today is about both. It's about selling to the Indian middle class, but also low-cost manufacturing. So it has a slight advantage over China 20 years ago. But the interesting thing about the Chinese consumer market is that 200 to 250 million people is expected to double by 2020. So the Chinese consumer market is going to grow significantly over the next few years, where the Indian consumer market will remain static, but it's still wealthy and the same size as China's today. But the demographic dividend in terms of getting people to work in India is much greater. So you'll start to see more cheap level or low cost manufacturing in India rather than you will in China. That'll manifest itself. Everybody's got made in China as a brand now. In 5 years' time, made in India will be the label in jeans and t-shirts.
China has seen much more rapid increases in salary over the past couple of years. Will this stymie future growth?
No, I don't believe it will. As I said, China is becoming, the Chinese nationals are becoming more wealthy, and this is a good thing. In fact, the middle class of China is expected to double, as I said, by about 2020. So instead of being a middle class of 200 to 250 million, you're going to see a middle class population in China of about 400 to 500 million people. That's more than the population of the United States, and I think for the first time really represents a consumer market that can now start to deliver up to those long-held promises of the market of 1 billion people. That always was going to take a long time to reach that objective, but for sure China is now a consumer market of global interest, and multinational companies and small to medium enterprises that have goods and services to sell to China should now be coming here and getting involved in the China demographics, which dictates that there is money here and the Chinese can and will and have the desire to buy international brands and services.
With rising labor costs a major concern for manufacturers in China, particularly in the south, is it more likely we will see factories moving to cheaper labor markets, or a push for an increase in productivity and increased automation?
That's an interesting question. Let's deal with the productivity and increased automation. China's working population is aging, and they are going to lose significant numbers of people from the workforce over the next decade. China's workforce is shrinking, but with that is increased automation. So China will become more automated, but that's okay because the workforce is also shrinking as well. So that both of those will lead to an increase in productivity. In terms of Chinese companies relocating or other companies relocating from China to other markets, perhaps in ASEAN or in India, there is a bit of that, principally in the textiles and agricultural industries. We have offices in South China, we have offices in Vietnam, for example, and we've seen a number of what were China-based businesses, particularly in South China, relocate to Vietnam, also some to Bangladesh. But generally speaking, those companies are also taking advantage of the new consumer dividend which China can provide, which is an increased number of a population that can afford middle-class goods. So what we're actually really seeing, the trend isn't closure per se of China-based factories moving to ASEAN or to Asia. It's actually that capacity to service China as a market is being moved to Vietnam or elsewhere, but just in order to take advantage of the lower manufacturing costs in Vietnam and ASEAN. ASEAN has a double tax treaty with China, which is being expanded, and it means that instead of add more workers to your factory in China, where labour is becoming more expensive, you would instead add more workers to your facility in Vietnam or elsewhere in Asia and export it to China from there. So there is a shift in where capacity is needed. Capacity is being added in countries such as Vietnam and elsewhere in Southeast Asia, as opposed to adding capacity in China. So there's a whole bunch of dynamics which come into play here, but you can't have both sides of the equation. You know, you either have a rising labour cost and an increasingly wealthy consumer market, but you can't have both. So I think that this is where ASEAN and countries like Vietnam can pick up the lower labour cost of that equation, whereas the focus should be on selling to the Chinese consumer market.
Moving up north a bit, it has been confirmed that Mongolia has the world's largest coal deposits and the second largest deposits of copper. Is Mongolia set to become a player on the world's commodities markets?
Yes, I don't think there's any doubt about that. What Mongolia needs is infrastructure. It is a democracy. They are aware of problems which they face with having massive amounts of wealth in the ground. There's an economic phenomena referred to as the Dutch disease, which reflects upon problems that Holland had in the late 70s and 80s, whereby large resources of oil and gas, and Mongolia is the same, although the commodities are slightly different, lead to a huge expansion very rapidly of the economy. That then kicks in inflation, of course. People are earning more money. Traditional industries in Holland, such as the auto sector, went broke. Shipping industry had problems. So the management of commodities wealth is a serious issue. Mongolia faces these as well. It also has traditional industries in agriculture and animal husbandry, the Kashmir industry, for example. There is inflation in Mongolia. The togrig, the currency, is the fastest appreciating currency in the world. So the whole process needs to be managed very carefully. The good news is that the Mongolian government are very much aware of this. I spend a lot of time there, and there are a lot of international advisors to that government, big international banks, Goldman Sachs, JP Morgan. Those guys are all there to make sure that the economy does not suffer from the Dutch disease effect. But without doubt, it is, as you say, Mongolia has massive amounts of reserves, not just in coal and copper, but also in uranium and silver. There's onshore gas fields, and it is going to become a major player in the global supply chain for these commodities, rare earths, and so on and so forth. That is going to happen. What I think is in the interest of the international community is to make sure that Mongolia is able to make that transition without too many hiccups.
China has been a top destination for retail brands in their global expansion. What about Vietnam? Are we going to see a similar flurry of activity in the coming years?
Yes, you will. It won't be as spectacular as China, purely because the Vietnamese population is not as large. But for sure, Vietnam, it's a young country. People there are working, they're creating wealth. It's still early days for them to start to have serious amounts of wealth, but for sure, in 10 and definitely 20 years' time, you'll have seen the emergence of a sizable Vietnamese middle-class economy, and they are and will increasingly be able to, just in terms of numbers, be able to buy luxury goods, imported products, and so on and so forth. So although that growth has been spectacular in China, China being much larger, you will see, I think it's without doubt, a smaller version, a scaled-down version of that happen in Vietnam. And again, I think it's an exciting, exotic, and stylish market. And I think that you will see the emergence of an interesting Vietnamese middle class of sufficient size to warrant investigation and investment by foreign investors there.
Thank you for joining us.
Okay, thank you. It's been a pleasure.
Thanks for joining us today. For more Asian business and regulatory news, visit our website at www.asiabriefingmedia.com. We love to hear your comments. Email us at podcast@asiabriefingmedia.com. Follow us on Twitter @AsiaBriefing. Visit our Facebook page. This podcast is produced by Asia Briefing Media for Dezan Shira and Associates. www.dezshira.com. That's DEZSHIRA.com. Thanks for listening.